Welcome to the Everything Financial Radio Show. You are listening to the Legacy Radio Network. I'm your host, Dennis Kubergen. And if this is your first time tuning in, we are here every week at this time, and we are glad you're with us today. We have a terrific show lined up for you. Mr. Karl Denninger, a prolific economic commentator and analyst, will be joining us today. We'll be getting his take on a statement made by Bill Gross this past week. Bill Gross, a very high-profile money manager, made what many would consider to be a very interesting, even perhaps radical statement this past week. He said, stock investing as we know it will soon be dead. We'll get Mr. Denninger's take, and I'll offer mine. Dr. Mark Faber, another prior guest here on the Everything Financial Radio Show, is predicting perhaps a bit of a rally in the S&P 500 to perhaps 1450 or 1500, but then he's looking for a correction as well. We'll get Karl's take on that. Also, why many cities are broke. The recent trend, particularly in the state of California, is for cities with large pension obligations to file for bankruptcy protection. Some of these benefits were, frankly, ridiculous. 52-year-olds retiring with a $200,000 pension after 3 years on the job. Is it any wonder some of these cities are broke? And how will it affect pension recipients? And if you receive a pension, we'll talk about that as well. Also, this past year, a study was done that now a married couple retiring last year may pay more in Social Security taxes than they'll ever collect in benefits. Also, S&P, the rating agency, Standard & Poor's this past week, downgraded 15 Italian banks. We're going to talk about a fundamental accounting flaw that's taking place now on the books and the balance sheets of many banks all around the world. Quick reminder, if you have not attended one of our discovery groups in the past, we have got a couple coming up this week. I think there's still a few seats remaining. We'll be over at Railside Golf Club in Byron Center on Tuesday, August the 14th. We'll be at Stonewater Golf Club in Caledonia on Thursday, August the 16th. You can go to personallegacyseminars.com. That is personallegacyseminars.com, and get more information. Also, we had such a tremendous response to our offer over the past month that we've decided to extend it. If you've not yet requested your 2012 guide, Surviving a Market Crash, you can request your guide by going to investingapproach.com. That is investingapproach.com. The guide will give you strategies and tactics to consider in today's economic environment. So again, to request your free guide, we'll send it to you at no cost, no obligation. Go to investingapproach.com. I'm pleased to have back on the Everything Financial Radio Show Mr. Karl Denninger. Karl is a prolific economic commentator through many different sources, his blog as well as his appearances on radio and television. Karl, thanks for coming back on the show today.
Oh, anytime. Thank you very much.
Karl, I was recently reading a blog entry where a gentleman by the name of Stephen Lieb, who's chairman of Lieb Capital Management, who is predicting a couple different things. Number one, he says that we're going to see a mania in gold similar to what we saw in the late 70s, and we'll also see a huge uptick in inflation. Your take on each of those?
I think he's crazy. Here is the problem in a nutshell. The inflation already happened. And this is where most of the guys that are doing analysis on this just aren't looking at the facts. Everyone wants to look at monetary aggregates because this is what the Fed tries to shoehorn you into. And this is the economic orthodoxy. If you go and get a degree in this stuff, this is what they will teach. The problem is that mainstream economists all ignore credit because they assume that it's going to be paid off. In other words, it's just a time shift. That's not true. We've got a 30-year history that says that credit continues to expand at a rate that exceeds that of GDP. Well, credit is nothing other than, in the economy, other than inflation because it spends exactly as currency does. So we have had 30 years from 1980 approximately until roughly 2007, 2008, where credit expansion, when added to monetary aggregates, has been at a substantial multiple of what you've seen in economic expansion. And where did all of this go? Well, one place it went was the stock market, 1,000 on the Dow to 14,000, 13,000. It went into house prices, it went into other assets. So, and it also, by the way, went into gold. All right, so there certainly was that. There was a speculative blow-off in gold about the time of the Iranian hostage-taking and the oil shocks. But then, as you saw, gold collapsed in price, and it kind of meandered around for a number of years, and now we've seen yet another takeoff. And this is on the idea that we're going to see gross currency debasement to the point that that's the only thing that holds value. The problem with the theory is that in order to continue to do that, you have to square it against the fact that people have to eat. And at the point that you run the printing presses, no matter how you do it, whether it's through credit expansion or through monetary expansion, to the point that people's purchasing power is destroyed and they can't buy their daily requirements, their food, their lodging, their energy needs, and things like this, then aggregate demand collapses and you get deflation instead. The history of these types of implosions is rather scattered because we've only got a couple of examples where this has happened, and Japan is one of the key ones. And what you need to look at is the bond market, because the bond market tells you what's going on in this regard. Bond market is always smarter than the stock market. It's just the aggregate of money flows and the amount of leverage that's there. And what you have seen in Japan, despite all the claims that there was going to be an imminent detonation in the bond market and crazy inflation, what Japan has had is 20 years of deflation. Okay. So
that's exactly what's happened.
Yeah, and this is the history, okay? So if you want to make a prediction that something different is going to happen here in the United States, then you have to look at things in the standpoint of a fiat currency environment where you have external pressures. In other words, you have trade that's going on, all right, and yet there is an alleged independent central bank that is in charge of monetary policy. And there are only two examples that we have of this in the modern era. One is the Japanese situation, and the second one's here. And Japan has run this experiment for 20 years. They have been unable to generate substantial and sustained inflation anywhere in their economy over that entire 20-year period. What makes people think we're going to be able to do it here?
Karl, I want to shift gears here just slightly because you're not of the mindset, and I don't want to put words in your mouth, but you're not of the mindset we're going to see a spike in gold prices. Is that correct?
I believe that we could see a disassociative trade, if you will, in gold as a result of, for example, if the European Union was to completely come apart. Okay? That is a distinct trade and a distinct cause from a hyperinflationary kind of trade. Hyperinflation is a loss of confidence in the currency. It is not sustained high inflation. What we saw in the 1970s and early 1980s until Volcker and policy came back in line with reality, which was initially caused by the oil shocks, was very high inflation, but it wasn't hyperinflation. Hyperinflation is the Weimar Germany kind of thing, or what happened in Argentina. And that is a loss of confidence in the currency regime that's currently in place. But it's very difficult to make that happen in an environment where credit expansion has ceased. And that is the environment that we have here today, and it's also the environment that that Japan had 20 years ago.
Well, thanks for the clarification. And we've got about 2.5 minutes left in this segment, so I'll ask the question, and we may need to pick it up on the other side of the break. Sure. This past week, Bill Gross was quoted in an article it's actually a Reuters article, and said that stock investing, as we know it, is about to come to an end. He says the Siegel constant of 6.6% real appreciation is an historical freak. It's a mutation likely never to be seen again. And also, as far as bonds are concerned, he said investors should expect mere survival from their bond investments. And Dr. Mark Faber, who's been a guest on the program, predicted a rally in the S&P to maybe 1,450 to 1,500 before it rolls over by, in his view, at least 20% or so. So both these gentlemen seem to be pretty bearish on stocks. What's your view?
I wouldn't call 1,500 bearish on equities, but I think that's overly optimistic. I believe that Bill has hit the nail on the head in a number of places. The parallel that you have in stock prices is of course 1929 and the 1920s with the move in the market that happened before the collapse there. The problem you have is that when you generate credit-based inflation, the money has to go somewhere, and where it goes is into pumping up some kind of asset price. Where it went in this case, and where it usually ends up going, because it's the highest velocity, is into things like stocks and, as we saw in the 2000s, into house prices. So the problem is that in the long run, stock prices are a reflection of the discounted cash flow of the underlying business. And that can't grow faster than the underlying economy, can it? Okay? So if you've had an outperformance for a period of time, what comes next? Reversion to the mean. And as a result, to expect 6+% appreciation is just lunacy. You've got this modeled into pension funds, though, and other fixed income areas, and there's going to be a great deal of pain when this becomes realized, because over a 30-year time frame, for example, this would put the Dow, at 200,000 or something crazy like this. That's clearly not going to happen.
Carl, in the time we have left in this segment, quickly let the listeners know where they can read more about your work and your views.
Market-ticker.org is my daily blog.
We will continue our conversation with Mr. Karl Denninger when Everything Financial Radio returns on the Legacy Radio Network. Stay with us.